How do small business owners pay themselves? I know for most of our working careers, we get a paycheck from the company that we work for. We're told how much they will pay us. If we're lucky, we can go above and beyond and get paid more through commissions or bonuses. Our taxes come out, and that's about all there is to it. Then you start a business, and if you do things right, checks are starting to come in left and right, and for amounts that you have never seen before. And it's tempting to just write yourself checks and use the company debit card for whatever you want and for however much you need in that moment because your account has enough in there. That's a really quick way and a road that will lead you to becoming one of the 20% of businesses that fail in the first year, or even the 50% of businesses that fail by year 5. I'm Megan Marsh, founder and co-host of the CoLab podcast and small business owner to a number of small businesses. Make sure you hit the subscribe button and the bell if you'd like to continue to hear topics on how to operate and succeed as a small business owner. And also ask me a question if I don't cover it in this video. So before digging into the ways to pay yourself, I want to make sure that you have a few things in order and understood about everything that involves how you get paid as a small business owner. The first thing is the type of entity that you have chosen to operate as does influence and impact the way that you can pay yourself. So let's run through the entity types. If you are a sole proprietorship, which doesn't require you to file business formation papers with the state or register. All of the profits and losses pass through you and are reported on your personal tax return. It's one of the simplest and easiest ways to operate when you get started. But you will have to pay state, federal, and self-employed taxes on all of your income. Your business name defaults to your own legal name, and you can take money out of your account at any time. And then the next one is your corporations, your S Corps, your C Corps. If you have incorporated, you hold more than one role. This means that you are an officer of the corporation, but you're also an employee of the corporation. And the most important thing when you operate as a corporation is to pay yourself a reasonable compensation under the payroll section, which we're going to dig into. The best way to do this is to determine what does the average CEO or whatever position that you have aligned yourself with, and what is someone that works in a company of your size in the region or area that you're in, and all the other factors, and really just use that amount. As long as your company can afford to pay you that amount, it may take some years to build up. And the best example that I can give you is if you have started a company and you are the accountant, controller of a business that brings in a couple $1 million, and when you look around, a controller of a similar type of company is getting paid around $75,000. That would be what a reasonable pay and compensation would be, and what you would want to work towards, or if you can do it right from the get-go, to set your salary under the payroll. So partnerships are when 2 or more people form a business where the owners do not take a salary or a draw. So they're not incorporated, they're a partnership. And instead, partners take distributions or shares of the profits based on how much of the partnership they own. That exact percentage of the profit can be paid based on the agreement that you've set up when you started the partnership. And then draws. So draws are what sole proprietorships take. When you take money out, whenever you take money out, you take them as draws from their business. And you can do it how you choose. Although we are now going to talk about some of the mistakes that a lot of business owners make when determining what their pay, what your pay should be. So the biggest mistakes that I see are when people mix their personal and their business bank accounts. And many business owners, especially sole proprietors or sole owners, will use their personal account for business deposits and expenses. And this not only makes tax time really difficult, but it also will make getting any type of loan very difficult. And the best example is, let's say you are a real estate agent. And as a real estate agent, when you receive a check, you just go put it right into your bank account for the whole amount. And you go out and have lunch and you use your debit card, and then you go buy pizzas for maybe a couple of your clients and one for yourself, and you use the same card. It's all one account. The best way that I recommend that you do this is you have your personal account that you always have had, but then you go open up in your name a business checking account. That's where all of your checks go into, every single one, and you compensate yourself by sending or writing a check to yourself that you put into your personal bank account. That is going to make everything so easy, and it will also help you qualify when you need to get a loan. The second mistake that I see a lot of business owners make is not setting aside money for taxes. I'm sure a lot of it is because most of us are employees for a long time before we become business owners, and we don't even think about the taxes that are taken out of our paychecks. So then when we begin receiving checks, let's use an example of an $1,000 check. We deposit that check into our bank account and we start spending it. And then when tax time comes and we get a bill for $12,000, let's say, we start panicking, maybe we cry, and then we start setting up a payment plan with the IRS. But unless you change something, this pattern is going to bite you in the butt. Year after year, all of a sudden, you're going to have a huge tax liability. And it happened to myself and my husband. The first few years we were self-employed until we started setting up a system to make sure the taxes were taken out of every check that we received. The third mistake is inconsistency. So changing the amount that you pay yourself is a really quick way to confusion, inaccurate view of your financials and how your business is doing. What I would recommend is that you look at your prior year, your profit and your loss, and determine how much you can afford to pay yourself consistently while still leaving some wiggle room for savings in your business. So let's now dig into the most common ways to pay yourself based on the entity you're in and that we're not making those mistakes. So first one is draws. So the sole proprietorship is going to take draws. So you've set up your separate bank account, a business bank account in your name, your checks from your sole proprietorship are going in there, and you've determined that you can pay yourself $3,000 a month. So then you could pay it once a month, you could pay it twice a month, you could pay it weekly, it doesn't matter. But make it consistent, and let's say you pay yourself twice a month, $1,500 is a draw that you're going to take, and you're either going to transfer it to your personal account or write a check to yourself to your personal account. A draw is how a sole proprietor pays themselves. Then the second type of pay is salaries, which a salary is a set amount that is paid every pay period. And the salary, though, is going to be paid a little differently based on the type of entity you are. So for owners of a corporation, the salary will be paid in payroll with all of your other employees, or even if you're the only employee, it goes through payroll. Just like when you work for someone, you're working through the corporation and you're getting a paycheck that you have determined the company can manage. If you're a partnership, the salary, you can still get a salary as a partnership, but it doesn't go through payroll. The salary is paid through what is called a guaranteed payment, and that's the next type of pay we're now going to talk about. So guaranteed payments are like the salaries, and it's paid every pay period. Let's say that twice a month again, but the amount does not go through payroll. It's paid directly to that partner that you have agreed to, and it's paid before taxes are taken out. So let's say in a two-person partnership, one partner is doing a lot of the operational work. They're getting $3,000 a month. So the company has a couple employees, they submit payroll. That partner's salary is not in there. It's a separate check that's written, no taxes taken out, and it gets paid to that partner. And the other partner doesn't need to receive a salary. It's just one partner because they're doing the work for it. It's before taxes, but it gets deducted from the profit and loss before the final company's partnership's profit is there. That is how partnerships get paid. A salary is through those guaranteed payments. And then the next type of pay is one that a lot of people who own businesses, you don't think about this one. And this is non-monetary compensation. And these are things that the business is paying for that is not part of paychecks. And, you would have to earn more than what the business is actually paying. So it's really important to understand this. And an example would be a cell phone. So my business pays my cell phone. And if your cell phone bill is, let's call it $200 a month. So my business is paying $200 a month before taxes, and the business writes off that $200 a month, and no taxes are ever paid on the $200 that pays the bill. Because if I had to pay this, if I was an employee somewhere and I was paying my $200 phone bill, I would have to make $260 of my paycheck because taxes of $60 would come out. I'd be left with a net of $200. So I'm really paying $260 as an employee, but the business is getting to pay $200. That is a non-monetary form of compensation. And people do this with cars that they use for their business, travel that has to do with business, coaching. I mean, all different types of things that you can put under your business now that you don't have to pay after taxes have already been taken out. And when the IRS eliminated unreimbursed business expenses, a lot of you who have jobs where you pay for expenses, that is one place where you're really missing out on those tax deductions. So then the last one that we're going to talk about is distributions. Distributions are whatever's left after payroll, after guaranteed payments, if it's a partnership, all the expenses get deducted from your profits. What's left at the end of the day? So how do you determine how much of your company's profit should automatically be considered yours to take home in the form of distributions? Even if you're the only employee of your business, how much should you take out? And you need to consider a number of factors if you want to be in business for a long time. Here's some of the questions that we look at when we determine the amount of distributions that we take. We start looking at, how is our company doing financially? Do we have things we need to pay off first? Are we planning on expanding our business, or are we staying where we're at? We knew last year we were bringing on 10 new people. So we knew we'd have to take on the salaries, the computers. So we knew if we had $100,000 in net profit, we could not spend all of that money. Next question is, how much in taxes do you need to set aside? So if your bottom profit number is $100,000, you're going to need to set aside, I'd recommend 30% in taxes. $30,000 first comes out and has to go to your state, your local, and your federal taxes. And then what were you paid when you were an employee in the same position? Make sure that, like we talked about earlier in the video, what is a reasonable amount that you should be making overall? What non-monetary compensation are you already taking? See, a lot of business owners say, oh, they have a salary, I'm making $100,000, when car, cell phone, those other things are in there, they're really making $140,000. And when we talk about those non-monetary compensation items, do you use them in the business? Could you put them under the business to save more in taxes? You just want to keep thinking about those things and what your business is using. To sum it all up though, no matter which way you pay yourself, no matter which type of organization you are, you can't pay yourself more than what is available in your profit and loss. You can't look at your bank account and say, I have $50,000 in there, I can write myself a check for $30,000. And let's say at the end of the year, your profit's only 25. And that's easy to do because money is constantly coming in and leaving. So it's really important to ask yourself the questions that I just went through, talk to your CPA about what type of entity you are, and constantly look and adjust to where you keep yourself in a really strong financial position. So if you'd like to learn more about running your small business from owners who have been in the trenches for years, tune into our weekly podcast, The Collab, where we talk about hiring your first employees, knowing your numbers, and many other topics. It's 100% free, and we've included a link in the description for you to tune in. I hope that this video gave you the insight you're looking for and that you will join us on our next episode of The Collab. And if you know someone who could benefit from this information, please share this video with them. Hit that subscribe and the bell to get further notifications. Otherwise, continue to check out all the business building tips and guides on our channel and learn from the business owners we interview on our next podcast.